Bankers promised that the housing market was unbreakable. They said it was mathematically impossible to lose. So they sold houses like hotcakes, but the reality was a global catastrophe that cost 30 million people their jobs and left neighborhoods looking like ghost towns. So, how did a safe investment accidentally delete $10 trillion and break the global economy? To find out, we don't need a finance degree. We just need to visit a pizza shop, run by a very convincing liar. To understand the crash, we have to talk about houses. Let's say Dave wants to buy a house.
I'd like one house, please.
I don't have that much money, but my credit is decent. Enter banker Bob. Bob gives Dave a mortgage. This is a simple contract. Dave gets the house, and he promises to pay Bob back over 30 years with interest. In the old days, Bob would just sit on that contract and wait 30 years to collect his profit. But Bob is impatient. He wants his money now so he can loan it to someone else. So Bob does something clever. He sells Dave's debt. Bob takes the piece of paper that says, "Dave owes me money," and sells it to a huge investment bank for cold hard cash. Now, the investment bank collects the payments from Dave, and Bob is free to go find more Daves. But the investment bank didn't just buy Dave's mortgage, they bought thousands of them, and here is where they got creative. They took all those thousands of mortgages and baked them into a giant financial pizza. They sliced this pizza up and sold the slices to investors. This is called a mortgage-backed security. If you own a slice of the pizza, every time a homeowner pays their mortgage, you get a bite of profit. It was a great system. The banks got cash, the investors got monthly checks, and Dave got a house. Everyone was happy, until they ran out of dough. The investors loved the pizza. They were hungry for more. They demanded more slices, but the banks had a problem. They ran out of qualified people to give loans to. Everyone with a good job already has a house. Who is left? Enter Steve. Steve is a risky bet. Hi, I'm a part-time dog walker. My income is kind of low, but I have a really good feeling about next year. Can I borrow $500,000? In the past, the bank would have laughed Steve out of the building. But now they needed ingredients for the pizza. So they invented the subprime mortgage. No income verification? No problem, just sign here. Approved. Bob took Steve's terrible, risky loan and tried to put it on the pizza. But the investors weren't stupid. They saw Steve's loan and hesitated. Whoa, wait a minute. That slice looks rotten. I'm not buying debt from a dog walker. He's going to default by Tuesday. The banks couldn't sell the risky slices, so they came up with a magic trick called a CDO. Imagine Bob takes the rotten slices of pizza, the risky loans from guys like Steve, and hides them underneath layers of really good pepperoni. Then, he puts the whole thing in a fancy box and pays a rating agency to slap a sticker on it. Looks delicious to me. AAA rating. Suddenly, that box of toxic debt was rated as safe as a US government bond. Investors couldn't smell the rot anymore. They bought billions of dollars worth of these boxes, thinking it was a guaranteed win. Technically, this was fraud, but the banks didn't call it fraud. They called it diversification. And as long as housing prices kept going up, nobody asked questions. It was a giant game of musical chairs, and in 2007, the music stopped. Housing prices leveled off, and the interest rates on those risky loans shot up. Hey, Bob? Yeah, the dog walking business is slow. I can't pay the mortgage. Steve defaulted. Then thousands of Steves defaulted. The money stopped flowing into the pizza. Investors opened their safe boxes to collect their checks and found nothing but eviction notices. The value of these assets hit zero almost overnight. And this is when the panic started. You see, banks lend money to each other every single night. It's the grease that keeps the global economy moving. But suddenly, no bank knew which other banks were holding the toxic boxes. I can't lend money to Bank of America. What if they're holding Steve's bad debt? They won't be able to pay me back. The trust evaporated. Banks stopped lending to each other. The financial plumbing of the world just stopped. This is called a credit freeze. You might ask, why do I care if banks stop lending? Because most regular businesses, like your local grocery store or car factory, operate on credit. They borrow money to pay their employees while they wait for customers to buy their stuff. When the bank stopped lending, the grocery store couldn't borrow money to run payroll. Workers didn't get paid. Factories shut down. The safe investment didn't just kill the stock market, it killed people's jobs. The 2008 crisis wasn't just about greedy bankers, it was about complexity. But the real lesson is simpler. Complexity is a disguise for risk. If you can't track exactly where your money is going, or if someone tries to sell you an investment using 100 fancy technical terms, run away. The rule is simple. If you can't understand it, don't invest in it. If you want to understand complex topics without the boring jargon, hit that subscribe button. We turn financial chaos into simple stories.